Private mortgage lending in Canada was once a small corner of real estate finance, reserved only for banks. But it is now an accessible vehicle for reliable, asset-backed passive income. Investors can earn monthly interest with mortgages registered in their names on Canadian property. This video will outline 4 private mortgage underwriting fundamentals to protect your capital, reduce risk, and lend safely. I'll also explain why, at least in the Canadian lending business, you get the best outcomes when you benefit your borrower. Responsible private lending and earning a profit go hand in hand. My name is Alexis Asadi. I'm a private lender, and since 2013, I've funded first and second mortgage loans across Canada. If you want to know more about how to become a private lender in Canada or how to invest in private mortgages, check out the free resources at asadicapital.com/learn. Before exploring the mechanics of underwriting, let's clarify responsible lending. In this context, I encourage you to think of it as a business strategy and not just a matter of ethics. Some companies view doing the right thing as a hurdle, but in Canadian private lending, the most profitable path is to align your interests with your borrowers. Doing the right thing will translate directly to revenue. Here's why. Private lending works best when your capital is deployed, earns interest, and is repaid smoothly. Conflict is generally to be avoided. Borrowers who feel misled, overwhelmed, or unfairly trapped have a greater chance of defaulting on the loan. When a person believes they were not fully informed or is charged fees that they didn't expect, they can become difficult accounts. In some cases, they can walk away from the debt or refuse to pay it. Of course, if this happens, you can enforce your mortgage and foreclose on the real estate collateral. Security is one of the main benefits of private lending. But focusing on enforcement is a weak business model because of the hassle and expense of doing so. The surest path is to ensure the borrower benefits from the loan, so they pay you back with ease. Now, in the US, some private lenders structure their loans to purposely trigger a default, and then they acquire the borrower's property. This is often referred to as the loan-to-own approach. This practice is predatory and is neither viable nor acceptable in Canada. Here, courts typically require lenders to sell foreclosed property for fair market value and return any excess proceeds to the borrower. Enforcement mechanisms exist to protect creditors, but they're not designed to generate windfall profits. These realities make clear that long-term profitability depends on well-performing loans rather than aggressive enforcement. So let's introduce the first practical measure to protect both your capital and your borrower: issuing a commitment letter. A commitment letter is a preliminary document that opens the file. It is issued before you begin any substantial due diligence on your borrower. The document sets out the terms of the loan you're willing to provide. It states the amount you're offering, the interest rate, security, repayment terms, deposits, fees, and other contractual items. The commitment letter also outlines the documentation that you require from the borrower, like bank statements, tax returns, appraisals, proof of insurance, and anything else relevant to the underwriting process. Both you and the borrower sign it. The commitment letter benefits both parties. The borrower gains certainty and can stop searching for financing. They can focus on getting you the due diligence documents. From your perspective as the lender, putting the offer in writing creates clarity. It makes clear what you need before you advance any funds. It reduces the risk of misunderstanding, especially when there have been negotiations. It also preserves your right to withdraw if undisclosed issues emerge. The commitment letter sets up the loan transaction and is a necessary part of due diligence. It creates transparency for you and your borrower. It can later be used by your lawyer to draft the loan and the mortgage documents. Next on the responsible private lending checklist is to assess whether the borrower can realistically afford your loan. While it can be tempting to ask for as much interest as possible, unsustainable loans almost always end in conflict. Your asset can become a liability if the borrower struggles to meet the monthly payments. Defaults lead to missed interest, stress, legal costs, stalled capital, and sometimes protracted enforcement proceedings. They also damage your reputation with brokers, lawyers, and future borrowers. Even when a borrower technically qualifies, an interest rate that leaves them with no financial cushion can set them up for failure. For example, charging 18% interest on a loan might not be worth it if the borrower is constantly late or misses payments. It can often make more sense to charge a bit less, maybe 14%, which is still an excellent return for you, but it benefits the borrower's stability. If a reduced rate allows them to maintain cash flow, the loan becomes more secure. A slightly lower returning asset that performs reliably is better than a high returning one that collapses. As a private lender, you can evaluate affordability by reviewing the borrower's tax returns, bank statements, and a detailed list of their financial obligations. You should include this request in your commitment letter. Once received, I usually enter these details into a basic spreadsheet to calculate the borrower's net monthly position. This prevents funding a loan that is destined to fail. Item number 3 on the responsible lending checklist is to ensure that the borrower is represented by their own lawyer. When signing the loan and mortgage documents, it's important for them to receive independent legal advice for 2 reasons. A, it ensures their understanding of the transaction, the risks involved, their obligations, and the consequences of default. You want an informed borrower. Borrowers who comprehend these matters are more likely to take the loan seriously, maintain the property, prioritize payments, and communicate proactively if challenges arise. B, independent legal advice protects you as a private lender. If a dispute occurs later, perhaps the borrower falls into arrears or claims they misunderstood the terms, they will have already received professional guidance that confirmed their informed consent. This removes any realistic argument that they were unfairly influenced, misled, or denied the opportunity to understand the legal ramifications of the loan. In fact, the absence of impartial counsel can be used against the lender. You should view the borrower's lawyer not as an obstacle, but rather a safeguard. They strengthen the enforceability of your mortgage and reduce the likelihood of future conflict. To ensure independence, do not recommend a lawyer or participate in choosing one, even if the borrower explicitly asks you for guidance. You should remain detached from the borrower's advisory process. The 4th responsible private lending practice is to provide your borrower with a detailed cost of borrowing statement. This explains how much the loan costs after accounting for fees, interest, and reimbursements. When looking at loans, many people only focus on the interest rate. For example, a $100,000 mortgage with a 12% interest rate may appear straightforward. However, if the loan includes a $2,000 lender fee, a $500 administration charge, and a requirement that the borrower reimburses the lender's legal expenses, the real cost is higher. A cost of borrowing disclosure converts these amounts into a single, comprehensible annualized percentage so the borrower sees the complete picture. Cost of borrowing disclosures are mandated in some provinces, but they should be standard practice wherever you lend. They promote transparency and they reduce the potential for disagreements. They protect you by preventing the borrower from later asserting that the fees were hidden, misunderstood, or never explained. One of the main lessons I've learned since the start of my private lending career in 2013 is to ensure my borrower and I are on the same page. I never bury terms in fine print or charge undisclosed fees. Ethics aside, lending responsibly is a good business strategy. When you take steps to ensure that your borrower understands the loan, can afford it, receives proper independent legal advice, and knows the true cost of borrowing, you're protecting the viability of your investment. Borrowers who are informed, financially stable, and treated with transparency are far more likely to make their payments on time, safeguard the property, communicate openly, and view you as a professional rather than an adversary. Every measure you take to protect the borrower reduces your risk. This video has outlined 4 of them, but there are plenty more that you can implement. Private mortgage lending is a secured investment, but it needs to be underwritten properly. I have lots of free resources for Canadian private lenders at asadicapital.com/learn. There are articles, courses, and videos that serve as tools for private mortgage investors, including how to structure safe private loans. I encourage you to watch them. Thank you.